In the late 1990s, thousands of internet companies raised billions of dollars, and almost all of them are gone today. But a handful of them didn't just survive. They became some of the biggest companies on Earth. The difference between the companies that disappeared and the ones that became giants wasn't luck. It followed a pattern.
And that same pattern is playing out again right now in AI stocks. By the end of this video, you'll know exactly what separates a survivor from a casualty and how to tell which kind of company you actually own.
Here's what we're covering. First, what actually happened during the dot-com crash? The real numbers, not the myth. Second, the handful of companies that survived, and the one thing they all had in common that the failures didn't. Third, a single number that has predicted every major stock bubble for the past century, and where it sits today. Let's clear up the myth first. Most people think the dot-com crash means the internet was a scam. That's wrong. The internet was completely real. It changed how the entire world works. The problem wasn't the technology. The problem was the price investors paid for it. Between 1995 and 2000, money poured into anything with .com in the name. Companies with no profit went public, valued at billions of dollars, sometimes with no real product. Investors weren't buying earnings, they were buying a story. Then in March of 2000, the story ran out of runway. The NASDAQ index dropped by roughly 78% over the next 2.5 years. Trillions of dollars in paper wealth disappeared. Companies that had never turned a profit ran out of cash and shut down almost overnight. But here's the surprising part. While thousands of companies disappeared, the internet itself kept growing the entire time. More people came online every single year, even during the crash. The technology wasn't the problem, the pricing was. All great technology changes produce bubbles. Not because the technology fails, but because investors overspend trying to win the race, before anyone knows who the winners will actually be.
So if the technology was real the whole time, why did so many companies still disappear? That's the most important question in this entire video. And the answer is Chapter 2.
Here's what almost nobody talks about. A small number of companies from the dive of the crash, they came out of it bigger and more powerful than before. Amazon is the clearest example. Its stock fell more than 90% during the crash. Most people at the time assumed it was finished. It wasn't. Building, it's one of the most valuable companies on the planet. So what did the survivors actually have that the failures didn't? It wasn't bigger hype, it wasn't a flashier website. It came down to 3 things. First, real revenue, not just user growth.
Survivors were already making money from actual customers, even if profits were thin. Failures were burning cash with no clear path to making any. Second, a real cost advantage or moat.
Survivors had something competitors couldn't easily copy. Logistics networks, brand trust, technology that took years to rebuild from scratch.
Third, they kept operating and investing through the crash instead of panicking and cutting everything. The companies that pulled back completely often lost their market position permanently. The ones that kept building carefully came out stronger once the dust settled. Most people don't know this next part. This exact happened again with the metaverse boom just a few years ago.
Billions were spent building virtual worlds. Most of it quietly disappeared because the underlying demand wasn't actually there yet. Same pattern, different decade. How do you spot the difference before it's obvious? Between a bubble about to pop and a real boom? One number has answered that for a century.
It's called the Shiller-Cape ratio, named after economist Robert Shiller. Don't worry, this isn't complicated. Here's what if comparing a stock's price to just 1 year of earnings, like a normal PE ratio does, the Cape ratio smooths out short-term noise. It shows if the market is expensive. Only this high 3 times in over 100 years. Here's why this number matters so much. Going back over a century, every single time the Cape ratio has hit an extreme high,
a smoke detector, not a countdown clock. It hit an extreme high right before the 1929 crash, and as of mid-2026, it has reached of one other time in history. That same markets can stay expensive for years. But here's the part people get wrong about this number. It doesn't tell you when the drop happens. Some markets have stayed expensive for years before correcting. It's not a timing tool, it's a risk gauge.
Think of it less like a countdown clock and more like a smoke detector. It tells you the risk of fire is high, not the exact minute the fire starts. This pattern matches the dot-com era
And a valuation number that's only been this high once before. Does that actually mean AI stocks are a bubble? Let's look at what's actually different this time, and what's actually the same. Here's what's genuinely different from 2000. Many of today's tech giants already have massive, real profits. That's a real difference from failed dot-coms. But here's what's the same. The spending pace is enormous. The real danger is debt payments coming due. Building AI infrastructure requires massive spending. That's being funded through debt. Even bank CEOs say, it may pay off, just maybe not on schedule.
not the technology. When debt payments come due and a company doesn't have the cash flow to cover them, that's when it's forced to sell assets. And that's when a slow story turns into a fast one.
AI spending may pay off, but not on the timeline most expect. The patience required might be longer and more painful. So the honest answer is, the profitable companies today look more like the dot-com survivors already looked back then. The heavily indebted, cash-burning ones look more like the failures.
The pattern isn't AI is fake. It's figure out which category your specific holdings fall into, and that's something you can actually check.
Here's how to actually apply all of this. Whether AI turns out to be the next Amazon story or the next cautionary tale.
First, check your actual exposure. If your portfolio or your 401k index fund is heavily weighted toward a handful of AI-linked megacap stocks, know that going in.
A fund can look diversified by name and still be concentrated in one story underneath. Second, look at the difference between real earnings and pure hype for anything you hold directly. A company with real profit and manageable debt is in a completely different risk category than one burning cash and betting everything on future growth.
Third, don't try to time an exact top or bottom. History shows corrections happen, but it also shows the investors who do worst are usually the ones who panic sell everything and never get back in before the recovery.
Fourth, keep your investing boring and consistent. Automatic monthly contributions through good markets and bad markets have outperformed most attempts to time these exact patterns. Going all the way back to the dot-com era. The lesson from history isn't avoid new technology.
Know the difference between the technology and the price you're paying for it. And that one habit is what separates the investors who survive a correction from the ones who don't.
So here's the real takeaway. Bubbles don't mean the technology was fake. The internet was real. AI is real.
What history actually shows is that overspending and overpricing during a genuine boom is completely normal, and so is the correction that eventually follows it.
The companies with real earnings and real advantages come out the other side bigger. The ones without them don't. Not a prediction of doom, a pattern you can actually use.
If this helped you understand what's really happening in AI, hit subscribe. We break down market history and what it means for your money every week here on Dollar Blueprint. No hype, plain English.
Drop a comment. Do you think your own portfolio looks more like a dot-com survivor or a dot-com failure? I read every one.